Good morning, everybody. Welcome to today's 1 million by 1 million online rendezvous. This is Sramana, Mitra, founder and CEO of 1M by 1M, coming to you live from Silicon Valley, California. 1M by 1M, as you know, is the first and only global virtual accelerator for startups in the world. Our mission is to help 1 million entrepreneurs reach $1 million and beyond in annual revenue. In support of the mission, we do a lot of different kinds of programming. This one is one of them, the online rendezvous, where we do mostly Q&A that we collect from all our different touch points through which we interact with our global community of over 500,000 people. In addition, if you are looking for feedback for your project, whether it is a project that you've already launched as a startup, as a business, it could be an MVP scenario, it could be a small startup generating a little bit of revenue, it could be a back of the envelope idea, it could be something that you're doing as a bootstrapping with a paycheck situation, you are just starting to scribble something on a napkin. All of those are fine. If you're an early stage entrepreneur or aspiring entrepreneur, we're very happy to work with you and help you put one foot before the other and realize your dream. Now, if you're looking for feedback on your particular project, your particular idea, this is not the right forum for that because this is not an interactive forum. This is more of a broadcast forum. You can interact with me in the public chat and the comments area. But the interactive forum where we actually brainstorm about specific projects and give you project-based feedback is our roundtables. That happens every Thursday at 8 a.m. Pacific time. So please dial in and actually go to the website 1mby1m.com and register to pitch or attend there. The whole roster is available. All the registration links and everything are available there. You can decide what fits on your schedule and book a slot, and then I will work with you directly on your specific project and give you feedback, strategic guidance, etc. Today, we're going to do another round of Q&A. So let's go to the first question. It is a question that is on many minds. What should be the strategy of startups to raise seed capital in 2021? 2020 is a tremendously unusual year. I don't have to tell you this. You know this in your bones, given what we are going through as a race, as a species. We are going through a collective experience of a pandemic. Once in a century pandemic. In addition, America is going through an incredibly turbulent election process that is threatening American democracy. Very unusual, very, very unusual. None of us have seen anything like this before. And then in part of the American West, especially California and some other states, we're seeing unprecedented wildfires. It's like one after another. And then on the east coast of America and earlier in the year in parts of South Asia, India, Bangladesh, etc., you've seen incredible hurricanes, cyclones, and it's like nature's wrath is coming down on humanity in a very strange, unprecedented way. At the face of this, entrepreneurs are still trying to realize their visions. Entrepreneurs are trying to build companies. They're trying to protect their fledgling companies. Entrepreneurs are trying to survive. Entrepreneurs are trying to preserve their long-term dreams. But you can only succeed long-term if you can survive the short-term, and the short-term right now is tricky, extremely tricky. So I think those who are struggling with cash flow issues are considering the question, should you raise seed capital? And if you do want to raise seed capital, how do you raise seed capital? And so on and so forth. So I'm going to address this question in some detail in this session. My first piece of feedback to you is, in general, bootstrap first, raise money later is the best strategy. If you can bootstrap your way to validation and ideally to a bit of traction, fundraising is a lot easier. So, our general guidance has always been, no, you should not always try to find seed capital right away. Bootstrapping is a better strategy. But we fully understand, recognize, and use, funding as a tool of building companies. Our philosophy is entrepreneurship equals customers, revenues, and profits. Financing is optional, exit is optional. However, financing is an optional but very powerful tool. And seed capital is a topic that, as an entrepreneur, you will need to understand. Even to make an informed choice, an informed decision about what your strategy is vis-a-vis capital raising, you will need to understand the topic. So I'm going to spend some time giving you some guidance on how to understand the topic, how to think about the topic, and then pointers to resources where you can double down on that understanding. Double click into that understanding, deep dive into that topic. If you want to even consider raising money, forget deciding to raise money, if you even want to consider raising money, I strongly suggest you read the 1M by 1M Seed Capital series of investor interviews on our blog. This is a free body of work accessible at your fingertips. We've profiled investor after investor to understand their investment thesis. Every investor has an investment thesis. No investor starts a fund without a point of view about how they will multiply that money. Remember, investors are looking to multiply the money that they put into startups. That is their sole agenda. Sole agenda. There is all kinds of other derivative points, but the primary agenda is to multiply the fund or multiply the money they put into startups. But there is a bit more sophisticated way to think about this question. Multiply by how much? 2x? 3x? 5x? 10x? 20x? This question determines the strategies of what they're looking to do. Are they looking to find unicorns? These are, unicorns. The definition of unicorns are companies with $1 billion market caps. So are they trying to invest in startups that are going to become unicorns, go from 0 to $100 million in revenue in 5 to 7 years, which effectively translates into $1 billion market cap companies? Is that the agenda? And that then we're talking about investors who are looking to multiply by 10x, 20x their investment. Or there's another category of investors who are looking for early exits. They want to invest in capital efficient startups, make a lower multiple, but a quick lower multiple, and have a successful outcome nonetheless. You should read my Bootstrapping to an Exit body of work on our blog. This is the strategy that this category of investors love. They want to put a small amount of money and practice mostly a bootstrapping philosophy, and then find a strategic fit and sell the company early. So as an entrepreneur, just like you look for product market fit, you also need to look for investor entrepreneur fit. A seed investor looking for a unicorn won't invest in a capital efficient startup that is better suited to a $30 million strategic exit. And vice versa. A seed investor looking to do a capital efficient startup and get an early exit will not invest in something that is going to require $200 million to become a $10 billion company. These are two completely different styles of investment. And both styles of investors exist. You need to figure out what is your agenda. So this is the kind of material. I've just given you a bit of a synthesis of how to think about this, but there are many nuances. Investors have geographical preferences, investors have sector preferences, business model preferences, teams situation preferences, technology preferences, different stage preferences, whether it's a pre-seed fund, seed fund, post-seed, pre-series A, small series A, large series A. There is like this whole spectrum of different types of seed investors. And you really need to understand how complex this market is. There are probably 1,000 micro VCs and angel investors out there, and you need to work through all that and find maybe 20, 30 investors who fit what you're looking for. By the way, the series that I'm talking about, our Seed Capital series, is also available as videos on YouTube. So you need to go to our YouTube channel, 1M by 1M Roundtables. So look for 1M Roundtables, and each roundtable typically has an investor guest where we discuss issues like this. The series is also available as podcasts on all major podcast platforms. So look for 1M by 1M Entrepreneurship Podcast, and you will find all episodes of this podcast series. Now, this is the investor entrepreneur fit question and how to figure out how you're going to get to an investor who will be willing to invest in your company. Then comes the question, how does an investor evaluate your project, the micro level evaluation? I'm going to point you to a set of questions that these investors are looking to answer. Go to the 1mby1m.com blog and go to self-assessment. This is a free tool that will help you understand the questions that you're going to be facing if you go in front of an investor to pitch. This is what you're going to be credible on. Question number 1 is validation. Have you validated your business with customers? Not with advisors, not with experts. Have you validated your business with customers? Question number 2 is positioning. Are you able to articulate the precise positioning of your solution? Question number 3 is monetization. Free is not a business model. How do you monetize? Question number 4 is TAM, total available market. How big is your market opportunity? This determines your financing and go-to-market strategy in a very significant way. And by the way, investors are only interested in bottom-up TAM analysis. Top-down TAM analysis Makes absolutely no sense for investors. Question number 5 is bootstrapping. Have you done enough bootstrapping before approaching investors? Is your company fundable, or is it one that needs to be bootstrapped all the way? Not all businesses are fundable. Over 99% of the businesses out there are not necessarily venture fundable. So you are going to need to determine whether you are fundable or not, and that in itself is a strategic process. And as I said right up front, bootstrap first, raise money later is the right way to do this, so that you can go in front of investors with a credible story that they feel like investing in. I will talk a lot more about bootstrapping in due course. Bootstrapping techniques is one of the most important things that you are going to need to learn as you think about your 2021 strategy. And of course, question number 6 is, should you raise financing? What is the timing when you need to raise financing? Do you know how to assess what is fundable, what is not? Have you already started talking to investors? Are you getting rejected by investors? Do you understand why? Do you need to move to Silicon Valley? Where are you going to raise money from? Investors based where? Then you have to figure out all the questions around valuation range. Can you enhance the valuation? What are the levers? What are the different types of financing options? Venture financing is not the only kind of financing. There are other types of financing that we have dug into and assembled. There are other types of investors who are willing to invest in your company potentially. You need to figure out strategically what is the right style of financing for you, given your stage, your business, your metrics, etc. All these are strategic questions that you need to think through. Number 7, customer acquisition. What is your customer acquisition strategy? What is the cost of customer acquisition? What kinds of conversion rates from traffic? What are the channels? What are the costs of those channels? What is the lifetime value of the customer? Etc. All these are questions that you need to answer. Point number 8 is team. How do you balance between your need to keep costs down and getting things done, as well as presenting a reasonably complete team to potential investors in case you are soliciting financing? Remember one thing, we are big fans of solo entrepreneurs. We support solo entrepreneurs all the time, because our belief is that everything starts with a solo entrepreneur, one entrepreneur thinking about something. That's how everything begins. And in these days of virtual companies and outsourced resources, Upwork and so on and so forth, outsourcing, globalization, you can attract contractors, subcontractors from all over the world. As a solo entrepreneur, you can actually go very far. Where you're going to need to stop and start thinking about what does your team look like is when you decide that you want to take the step of raising money. Solo entrepreneurs can raise money, but you need more validation and more traction before a solo entrepreneur can raise money. And then the assumption from the investors is that, yes, okay, we can recruit the team because the business model is already validated. But if none of that is validated and you're very early stage, and then team is one of the most important things that investors fund. And today most of what we work with are web, mobile, and social businesses. So online, cloud businesses, mobile businesses, social businesses. Do you have a differentiated strategy? The markets are extremely crowded. Every sector is extremely crowded. But there are trends and there are gaps. Do you understand what those are and why it makes sense for you to do this venture at this time? Timing is incredibly critical in evaluation of whether a company is going to scale or not. So that's my summary of how do you figure out your fundraising strategy. I'm going to spend a lot of time on bootstrapping techniques as we go along. Okay. Today, the second question that I'm going to address is, how do I find angel investors in my industry? Again, I suggest that you read the 1M by 1M Seed Capital series of interviews on our blog. We profiled investor after investor to understand their investment thesis. And in particular, to find investor entrepreneur fit, you're going to need to understand the stage, the geography, the fund size, unicorn or early investment, industry sector, expertise, unfair advantage, all of these points of each of these investors. And then you need to shortlist which ones you would like to raise money from, and you have a fair shot at raising money from. What did I say earlier? Just like you look for product market fit, you also need to look for investor entrepreneur fit. A seed investor looking for a unicorn won't invest in a capital efficient startup that is better suited to a 20, 30 million, 50 million strategic exit. So that's my guidance on looking for companies. Now, one thing is to find the right investor, you have to shortlist, you have to study the body of work that I'm pointing you to, and you have to shortlist what suits you, your agenda, your business, your venture. And then, the vast majority of angel investors, VCs, micro VCs, they all work on the basis of warm referrals. They have trusted referral sources. We are one of those. So you're going to need to be introduced to these investors by somebody whom they trust. So you're very welcome to join the 1M by 1M premium program, and we will introduce you once you meet the criteria of being introduced to an investor. So there are fundability criteria that you need to understand. So, but we do have all the facilities of getting you in front of investors. That facility exists. We have, if you are at a stage where we are comfortable presenting you to investors, and we will help you get to that stage as well, we are perfectly okay to, maybe in 1.5 hour session, I will be introducing you to 30 investors. And then within a 24-hour period, you'll probably hear back from 50% of those, and then we'll see how they respond and so on and so forth. But this kind of, rapid fire introductions, are not so easy to get unless you are part of a program that has those relationships, has built those relationships, those trusted relationships over a period of time. Y Combinator has those relationships. Techstars has those relationships. We have those relationships. So you need to be part of a program so that you can access that kind of credibility, credible introductions. The next question is, what does an investor checklist for startup due diligence include? Well, I just pointed you in the previous question to the 1M by 1M self-assessment. So go to the website, 1mby1m.com, go to self-assessment, and that's where you'll find the due diligence questions. And basically they're around validation, positioning, monetization, TAM, bootstrapping, financing strategy, customer acquisition, strategy and cost, team situation, and differentiation. So that's my answer to that question. Here's an interesting one. What was the original founder equity split among some well-known startups? To answer this question, I'm going to preface my analysis of a particular case study, which is Facebook, by saying ownership matters. And listen to why. Mark Zuckerberg retained 26% equity in Facebook. Zuckerberg's net worth is, over $100 billion, I think, at this point. I think the last time I actually checked his net worth, it was $52 billion in January 2017. 3 years have passed by, actually almost 4 years have passed by. He's insanely rich. How did he retain 26% ownership in Facebook? Facebook started with friends and family money in February 2004. By September 2004, it had ad revenues. Peter Thiel invested the first outside money. Peter Thiel invested $500,000 for 10% of Facebook. Many startups get $25,000 for 10% equity. There are tons of incubators and accelerators out there that take 10% equity and just give you $25,000. Please avoid this kind of term sheet. Bootstrap. This $25,000 for 10% equity is just not worthwhile. Peter Thiel invested $500,000 for 10% of Facebook. That kept the cap table healthy. Facebook remained attractive for follow-on rounds. Let's look at all the Facebook rounds. September 2004, $500,000 in seed, valuation $5 million. May 2005, $12.7 million Series A, valuation $100 million. At this point, Facebook is growing like wildfire. Campus after campus is adopting Facebook. And it's starting to get out of campuses as well. At that point, in May 2005, the revenue run rate is $6 million. So all along, in Series A itself, Facebook is monetizing. May 2006, $27.5 million of Series B financing. Valuation, $525 million. Everyone was talking about Facebook. Zuckerberg was hailed as the next Bill Gates. Zuckerberg wielded a lot of negotiating power in each round. Facebook was a rocket. VCs were begging to get in. Zuckerberg did not get carried away. October 2007, $240 million Series C, valuation $15 billion. Revenue run rate $150 million. Yahoo wanted to buy Facebook for $1 billion in July 2006. Investors wanted to sell. Zuckerberg did not want to sell. Zuckerberg won because he had ownership control. He could not be overruled by his board. 2 lessons from Zuckerberg. Don't raise too much money too soon. Focus on revenues to keep valuations high and minimize dilution. Ownership matters. Use a non-equity accelerator if you can. Don't raise money too soon. 1M by 1M doesn't charge equity. Early funding destroys cap tables. Destroyed cap tables equals disaster for future funding. Be like Zuckerberg. Take care of your ownership. So I've talked quite a lot about bootstrapping. I'm going to give you a pointer to my free bootstrapping course that I recorded for LinkedIn a while ago. It has been very popular. You can just go to our website, 1mby1m.com, and do a search on bootstrapping course and you'll get to it. It's available there as well. And the other thing that I'm going to point you to is Entrepreneur Journeys case studies. Go to, again, our blog. Go to Entrepreneur Journeys on the left navigation panel. Go to those case studies. There are 1,000+ case studies captured since 2006 to present day. 100+ unicorns, 400+ venture-funded companies, 400+ bootstrap companies. There are 12 books based on this body of work. The entire 1M by 1M curriculum is built on top of these case studies. You can access the curriculum only by going to 1M by 1M Basic. This is our case study based curriculum only option. That's just $99 a month. If you are, however, looking for introductions, weekly mentoring, etc., especially investor introductions, you need to join 1M by 1M Premium. And again, go to the website and you can join 1M by 1M Premium from the website. I look forward to working with many of you over the course of this next few months as you face incredible challenges to keep your fledgling startups alive and thriving. And in that process, whatever help you need, whatever help we can give you, we will. Remember, we work with technology and technology-enabled services businesses only. This is 1 million by 1 million, the first and only global virtual accelerator in the world. Goodbye, everybody. Good luck. Stay safe. The pandemic is raging. In a lot of places, the pandemic is rising, unfortunately. And the White House is now the center of a contagion that looks really precarious and makes the American government looks really silly. So please don't follow suit. Please don't risk yourselves. Please don't be reckless like Trump is being reckless and catch COVID. You are entrepreneurs. You need to protect your companies. You cannot afford to get sick. Good luck. Bye-bye.